Hello, everybody, and welcome to another Capital Gains Tax Solutions Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to create and preserve more wealth or help your clients, friends, and family do the same when exiting any asset of any kind, as long as it has $1 million net proceeds and $1 million gain, so you can create and preserve more wealth or even grow your business by helping your high net worth clients. For those who don't know me, my name is Brett Swarts, and I'm founder of Capital Gains Tax Solutions. And every single week, we are here breaking down live deals, case studies, getting tactical with the deferred sales trusts. So again, that you can feel confident in your exit plan, right? And by the way, sometimes it is a deferred sales trust. Sometimes it is a 1031 exchange. Sometimes it's a Delaware statutory trust. The key is you want to know what options you have available to you and what's the best way to unlock the freedoms that you want for your wealth. By the way, if you're watching this on YouTube, you can subscribe to our YouTube channel. We so appreciate them out there. We're also streaming on Expert CRE Secrets as well. So we appreciate all of the listeners who are learning about commercial real estate and wanting to grow their wealth in that way. So let's start with this. Investment strategies with the deferred sales trust is the topic of today. And we have found that one of the best ways to invest is to do it at optimal timing. And having a strategy beyond just tax deferral is just as important as the tax deferral strategy that you have. And so we like to coin this or say it's not just about tax flow. It's not just about cash flow. It's about tax flow. And kind of the bigger picture is about wealth, building and connecting these three things together is what helps to build a effective investment strategy, right? Right now, given the time and place of the marketplace, it feels as if we're not quite sure what's going to happen with what asset type. Is the stock market going to go higher or lower? Interest rates going to go higher or lower? Is real estate, is it going to have a big crash? Or what's going to happen with certain parts of real estate, with single family or for multifamily or for industrial or office buildings. And essentially, there's a lot of uncertainty in the marketplace. And this is why it's so important to have a strategy to make sure that whatever you're investing, you have an opportunity to have diversification, liquidity, and optimal timing to buy into investments. And that's the beauty of the deferred sales trust, or even things like IRAs or 401ks, where you can do self-directed into real estate, or you can be diversified into liquid investments. And you're not bound by just one single asset type. Now, my bias is real estate, just because I grew up knowing, loving, and trusting real estate. Value add, hands-on, either development or multifamily has been my to, and it's worked out very well. But guess what's happening right now? We're seeing a lot of people that are in a debt that's adjusting. They have good real estate properties operationally, occupancy, and even management, but the debt has adjusted and it's putting them in a weakened position, right? In other words, it's kind of like it's poisoning the deal that was so good just a short 24 months ago. Now it's becoming bad rapidly fast. And so that's where you want something that's not going to force you into staying in that investment. In fact, we just closed a deal for a client in San Diego, and they were looking at a substantial amount of tax, about 40% of their gain. And this is on an investment piece of real estate. And for them, they were looking at their investment strategy moving forward, which wasn't having all of their wealth tied into real estate in a highly appreciated area like San Diego. They said, how do I diversify the wealth? And how do I, pay off my debt as well? How do I create even more cash flow? Because a lot of the assets that have appreciated, especially places like California or New York, these higher wealth attending real estate places, the wealth is built up and it's time to harvest. Meaning the cash flow is maybe not a return on equity. It's out of balance, right? And so there's a time to sell, there's a time to hold, and there's a time to diversify. And so building out an investment strategy with the deferred sales trust is as simple as A, finding out what options are available, B, having a game plan for when and how you want to invest into those funds. And I think also having a tax flow and a cash flow mindset coupled with a team to help you execute this strategy. That is the kind of the thesis for today, and we're going to be diving into that. I do have Jake Carpenter, one of our strategic alliances, financial advisors, wealth advisor out of Washington. Jake Carpenter, how are we doing today?
Great, Brett. It's great to be here.
What would you say? What would you say the number one secret is, Jake, to developing a effective investment strategy as it pertains to the deferred sales trust?
Well, the main word that you're using here is timing. And timing can mean more than just it's the right time to sell. Timing, specifically in comparison to a 1031 exchange, when you go into a 1031 exchange, number one, it only works on investment real estate. And then you have the timing of identifying in 45 days and closing in 180. So what we want to do, Brett, is take folks, whether you want to start out with a 1031 exchange or not, and put them in a position where ultimately, when it's all said and done at the end of the day, they have the ability to defer the capital gains tax on the sale of not just investment real estate, but also businesses, cryptocurrencies, individual stocks, and any highly appreciated asset. Defer that capital gains tax at closing, and then not have to have a 45 to 180 day window. Then we can take those proceeds, and the mantra with all of us investment advisors and financial planners is you need to sell high and buy low. Well, obviously, if you're selling, it's probably a good time to sell. So you just sold high. You might want to stay on the sidelines long enough until you decide what deal makes sense to you. And that could be 45 days, that could be 45 months or longer. But we want to give the ability for sellers to be able to control their timing so they can truly buy high or sell high and buy low, and then diversify them out in different asset classes so they're not having to reinvest into like-kind property. They can reinvest in a multitude of different assets to position themselves to be able to quickly move into the deal that makes sense for them. So timing is definitely important, probably one of the most important things, and timing in different realms.
Good. Excellent, Jake. And that's Jake Carpenter, carpentercapitalllc.com. Thank you for sharing that, Jake. Also, I think timing is interesting in the fact that not only for investment performance and opportunity to pounce on low, priced, either be it stocks, be it real estate, be it business ventures, but also timing just for your family, right? For the time and energy that you're putting in for what is most important for you and for your life and for your family. And investments should be as a part of helping you to unlock the freedoms that you desire, right? Either that being cash flow, or whether that be just, being able to sell an asset that otherwise takes up a lot of time and energy and stress. And so the ability to change your lifestyle based upon exiting an asset that produces that cash flow, right? Or even increases your cash flow. In fact, we have found to build an effective deferred sales trust investment strategy, you're typically increasing 20, 30, 40, 50% in cash flow from what you're selling, right? And a lot of that asset is tied up. Again, in that the wealth is tied up into this asset. And now you're selling and putting into something else that's producing much more cash flow, which could free up the most valuable thing, the thing that we can never get back, which is time. And the countless and countless families that we've worked with and helped over the years, that is the one driving force. More time with grandkids, more time traveling, more time, charitable causes, or some kind of entrepreneurial dream they've always wanted to do, or building real estate, right? Helping to create housing for people that don't have housing. These types of things that are the impact. And so I think an effective investment strategy not only makes selling high and buying low to increase cash flow, but it's unlocking the ability to make an impact with your wealth. I want to pass it to Jake Miller, one of our top strategic alliances financial advisors, certified financial planner. Jake, what are your thoughts on building an effective investment strategy with the deferred sales trust?
So part of the effectiveness of it, Brett, is already solved. with the deferred sales trust itself, in the sense that it is a tax efficient vehicle, we are already deferring for those taxes. You are already starting your investment with sometimes 20, 30, 40% more capital than you otherwise would have had you had to pay taxes prior. Now, within your deferred sales trust, the proceeds that are there usually came from the sale of a highly appreciated asset. Oftentimes that means that all your eggs were in one basket. It was a warehouse, it was crypto, it was that racehorse, whatever it was that you sold. Now you're able to diversify, and you're not subject to those limitations of 45, 46 days, 180 days. You're not subject to what kind of assets, as long as it's not personally used. You can actually diversify your assets and your holdings within the deferred sales trust, and you can do short-term lending. You can invest in crypto if you wish. You can invest in real estate. You can invest in assets outside of the country with your US deferred sales trust. There's a lot of different things that you can hold there, Brett. And so with that being said, it more easily aligns with your objectives. And that's what we sit down to help establish. And you, as a fiduciary, as the trustee, help them accomplish.
Good time to go into kind of the roles. In fact, I'm bringing in Rebecca Munson, one of our strategic alliances and luxury agents, realtors up in the Truckee, Lake Tahoe area. So Rebecca, talk about some of the roles within the deferred sales trust. And if you were selling someone's house and helping them to, build out some kind of investment strategy with real estate, what are some of the roles and what would that look like?
Some of the roles that the deferred sales trust plays. Okay.
Yeah, it would be like the trustee, the attorney, the financial advisors. From someone who may learn this for the first time, might be selling some real estate. How would you go about explaining that so someone could digest it?
Sure. So, in selling that property, that real estate property, you are going to be selling the property to the trust. And then the trust is going to be the property owner when the actual transaction happens. So then you don't actually, the individual or doesn't actually receive any of the funds. So then, and then you work with the trustee and a financial advisor to figure out what you're going to do with those funds, right? So you never are in receipt of those funds. So therefore you don't have any taxable gains.
Yeah, exactly. It's kind of like a delayed tax trust, right? Is another way to think about this. You're delaying receiving payment, which means you're delaying the tax. Also, it's kind of like an IRA or 401k and kind of like a 1031 exchange, and that at the close of escrow, you're not paying tax on what you haven't received. Right? It's deferred, it's growing, it's building. And so there's really just a couple roles. There's, like Rebecca said, there's a trustee. That's our role here at Capital Gains Tax Solutions. We're sort of like maybe the offensive coordinator. Sometimes we're the quarterback on real estate deals. Sometimes we're the guy on the sideline cheering you on for the next business venture that you're an entrepreneur. So we really customize our approach to our clients. But our main role is to work with you and then to find the best. And I mean the best financial advisors, the best CPAs, the best real estate investment groups to help to steward this wealth in a way that's going to get you money back, plus a rate of return, net of recurring fees, and also other ways to build wealth above and beyond just the interest rates. And so that's the beauty of the deferred sales trust, is that you do receive a team that is dedicated to focusing like a laser to helping to get the money back to you, plus a rate of return. In the meantime, you're using what you would have paid in tax to grow wealth. And that's the beauty. It's the law of compounding interest. Most of these promissory notes, by the way, is what you receive at the close of escrow, are somewhere between, let's say, 6 and 9%, sometimes 5 to 9%, depending on the risk tolerance of the individual, and depending on a couple other things as well. But ultimately, let's just say it's $1 million in the trust at 8%. Well, that's an $80,000 of cash flow would be the goal per year. End of 10 years, let's imagine it had paid you the 80 and you would have paid on that million, you would have paid, let's say, 400,000 of tax or 300,000 of tax. Well, instead of having 700 or 600, there's been the full million every year in the trust, plus paying you about that 8%. Now, it's not a guarantee. We have to go make the returns on the investments, and that's part of why you have the team to focus like a laser to help you grow the wealth. And at the end of the 10 years, you can take the full balloon payment and pay the tax, or you can also renew it for another 10 years and continue on to defer and grow wealth. If you pass away, the trust can go inside of your living trust, and your children can inherit, step into your shoes, the promissory note, and continue on. So, Rebecca, if someone were selling a luxury home up in Lake Tahoe, and it's not quite an incline village, right? Because that would be Nevada side, so it's higher. Although it could also work for Nevada side as well, especially if you have an estate tax. Let's imagine someone owns a $50 million property. Let's use Nevada, right? Because this will be good. Because even though they think, oh, it's only 20%, right? I don't have the state, of Nevada capital gains tax. It's just 20%. But walk through what the challenge might be for the estate tax as you understand it, Rebecca.
So currently, the estate tax is also $12 million single, 24 million married. So let's say you're selling a $50 million property, and you bought it for 10 million. That's $40 million, right? All of a sudden, you're going to have to pay not only the 20%, plus you're going to deal with the state tax as well. Correct?
You got it. Yeah, you got it.
Okay.
And so what we're talking about is solving estate tax using the deferred sales trust. Most people are factoring in just capital gains tax. Either, hey, I'm going to pass away, die, and give it to my kids with a stepped-up basis on that 50 million, right? And so they go, I don't need to do a 1031, and I don't need to sell. But what they don't realize is the Yellowstone effect. Have you seen the show Yellowstone? Kevin Costner, the whole show is about the family trying to help him keep the land, and then even maybe sell the land because people want to put, casinos and airports and all this stuff. But more than that, if he dies, then the estate is assessed, and on this, let's say $100 million worth of land, he's going to pay, about 40% in tax minus the exclusions, right? And so they're like, Dad, you're going to lose it anyways, right? And so understanding that cap gains tax and a stepped up basis to 1031 only is this one realm. It's the tiger by the tail. The big elephant is this estate tax, right? So a good approach, if you're a real estate agent, is solving more than just capital gains tax. It's solving estate tax, right? Estate tax, which is 40%, also known as the death tax. Jake Miller, you want to add or subtract any of that? Any thoughts on that?
Yeah, so currently the existing exemption, or our free window, so to speak, of where we are exempt and don't have to pay taxes, could change at any time. I often say that's one of the biggest mousetraps that the IRS has. In fact, it wasn't maybe 20 something years ago that it was only 600,000. 12 million, 24 million, 600,000. And the fact that here at the end of 2025, 2026, it resets back to what it was in 2017, we can see that this is a moving target. And so as much as you are planning for your estate, just be aware that any given moment with one fell swoop of the pen, Congress can change what that number is today. And you might be subject to that 40% estate tax on top of the income taxes, on top of all the other taxes, without being prepared. So that's why freezing the assets within your estate using a deferred sales trust 2.0, etc., can be a very strategic estate planning maneuver, while allowing those assets to grow outside of your estate post DST.
Absolutely. And so what we're saying here is, instead of one swoop of a pen from the Congress to change those exemption amounts, what we're saying is we can solve your estate tax with one swoop of the pen of selling your asset with the DST Plus in place, DST 2.0. And in one day, one transaction, does take a third-party buyer, we can move all of the funds outside of the taxable estate. And that is the beauty of this. And this can help you win listings, do more transactions if you're a business professional, if you're selling real estate, or if you're just the high net worth client. This can make all the difference for your family and for your legacy, for your wealth. If you want to learn more about this, you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. That being said, we want to open it up a little bit for anyone in the audience who wants to say hello, questions, comments. And by the way, if you're watching this on YouTube, you can like this video. That'd be fantastic. We so appreciate that. You can also subscribe to the channel. And you subscribe to the channel, it gets more opportunity for more people to see how the deferred sales trust can help them out, another capital gains tax deferral strategy. So with that, do we have anybody who has any questions? You can say something in the chat, and you could also unmute yourself and say hello to us. And Jake, Rebecca, both Jakes, Rebecca and I would love the opportunity to talk with you on maybe a client's deal or your own deal. Happy to connect. Let's see. We'll give it a second here. I say 7 seconds is usually good to give the brain a chance to respond. That's what I try to practice with my wife. It's like, can you pause for 7 seconds before talking, Brett? I can try. Jake, where are you today, by the way? Miller, where you at?
I'm in the city of Eternal Spring. I'm in Medellin.
Okay. One day. It's on the list. Rebecca, are you in Truckee today or Lake Tahoe? Or?
I am in Truckee today. Yeah.
Excellent. And I'm in St. Augustine, Florida, for those who don't know. Recently moved from Taxifornia out here, so hanging out. Jake Carpenter, you up in Washington today?
Yep, Washington State.
I just saw Jake Carpenter, 2 weeks ago now, San Francisco, at the event. That was a good event.
Really great event, family office, a club event.
And while we're speaking of that, there's a couple of events I want to invite everybody to. It's a DLP Capital event coming up in St. Augustine, Florida. This is coming up in November 8th through the 12th. It's the Family Wealth and Legacy event. Love the opportunity to see you there. Also, we're announcing today as well, we're going to be having our first annual Deferred Capital Gains Tax Solutions Deal and Tax Flow Summit. It's an online event that'll be coming up on December 15th. More information to come on that, but it's going to be on a Friday, December 15th, and it's going to be a full day event. We're really excited for what that is going to be, and more information to come on that. Looks like we have no questions, which is remarkable, which is cool. But I see Jay, John, I see David, I see Claire. So feel free to, if you guys have questions along the way, but otherwise we will keep talking. Let's see here. Jake, do you want to throw up a question for me? And then I'll throw out one for Jake and Rebecca, and we'll do a little ping pong of, frequently asked questions or challenges or objections you received. We do have a question. All right. David asked, if my mother's house is in a family trust, would she also need a date for estate planning reasons? Will she need a DST for estate planning reasons? I'm not sure if that's exactly what you mean, but I'll answer as if that's what you meant by that. So it all depends, David, right? So a living trust, which is maybe like a family trust, what you're referring to, has to do with probate, right? Meaning instead of the kids or the assets going through a government entity to decide how and where the funds are going to be distributed to the heirs or whomever, probate basically says, or a living trust basically avoids the probate, and it just goes directly to the people who are going to be receiving it. It's also much cheaper, less expensive, but tons of people don't have living trusts, and it's astounding to think about, right? So get your living trust done. So it sounds like she does have that, and that's a good thing, right? Now, the deferred sales trust, there's thousands of different trusts. This is a business trust that has really nothing to do with your living trust, although the promissory note would be put into the living trust, right? So the asset in which your mom would have if she sold the house would be this promissory note. The money's owed back to her, right? Let's call it a note receivable. Let's just say it's a $3 million exit and it's owed at 8% interest rate. That would be inside of the living trust. So upon her passing, and if dad's not around either, then it would pass via what the living trust would say. Let's say it's a couple kids, you and a couple others, whatever, right? And the cash flow can start to pay you guys, and or you guys can pay your tax. And so that's the short answer there. If she has no capital gains tax, it needs to be $1 million net proceeds, $1 million gain. In fact, on primary homes, we like to see $2 million net proceeds and $2 million gain, generally speaking, because they have what's called that 121 exclusion. So we actually like to double the amount to make it worthwhile. So hopefully that answers the question, David. Feel free to unmute yourself and ask the question or in a different way if I didn't answer that. Happy to dive in a little bit more on that. And I have this second question I'm going to pass to Jake Miller. It says, can you run through the process again? I have a client, Jake, that it sounds like, who is selling a $2 million income producing property, and they need income, but also would like to defer the cap gains tax. And then I'll get back to you, David, in a minute. So Jake, you want to take that? It's a question from Ross.
Yeah, absolutely. Ross, thank you for the question. Essentially, should your client use the deferred sales trust, what happens is the trust itself is set up prior to the sale. So it's really important that we get in front of things when there's a letter of intent, when you're negotiating, when you're getting serious, so that up front we can educate everybody, buyer, seller, anybody that needs to be involved. A lot of times, the buyer, it doesn't really matter to them as much, as long as you're not making changes during the 11th hour before signing, right? So we work with you so that we can transfer, let's see, this $2 million property into the deferred sales trust that is newly set up for you to sell from. The trust receives the proceeds. You don't receive the proceeds. That's why you don't have constructive receipts and you don't pay taxes now. The trust issues you a promissory note for the asset or the $2 million that you put into it. Now that the trust receives the proceeds of the sale, the trust can then diversify and invest. Think of it as a 401k. Once money's inside of there, you can buy, you can sell, you can buy, you can sell, you can buy, you can sell. All these transactions are not taxable to you today. Everything is being deferred once it's inside of this shell that's outside of your estate. And so essentially, just to repeat myself one more time, you can utilize the deferred sales trust. You can exchange property that you're selling into it in lieu for a promissory note. So now what you own is a promissory note. You become a lender or a creditor against the assets of the trust. The trust then sells those assets and can reinvest. And that's kind of how the deferred sales trust works.
Excellent. Great job, Jake. A little nuance to make in case you might have missed it. There's a DST 1.0 and a 2.0. 2.0 is outside the taxable estate. 1.0 is still inside of the taxable estate and will be need to be put inside of the living trust, right? You also want to do the estate planning with the DST 2.0 to make sure you actually name the beneficiaries on the 2.0 right at the start. On the 1.0, it's just a promissory note. You'd put that inside of the living trust and the beneficiaries. That's a little bit technical, but just in case you're wondering. And of course, they can get income from the trust, right? That's the whole idea. Let's just say this is a $2 million income property. Let's say it's a zero basis. Let's imagine it's California. They're going to pay about 40% of tax. So they got about an $800,000 tax bill, or they can put all of the money into the trust at 2 million versus 1.2. And that's the beauty. The funds can be invested into real estate, passive or active, the stock market, liquid investments, illiquid. It can partner with them. Very flexible. But let's just imagine it's earning about 8%, which is not uncommon net of fees on any 10-year period of time. That's about $160,000 of cash flow. And so the key, I think we also run these scenarios. In fact, I just helped a client, I'm a broker myself, sell a $2.5 million property in Sacramento, a multifamily property, about 15 units. Their cash flow, their NOI was about $120,000. And so for them, they said, you know what, it'd be great to be able to increase our cash flow and increase our time and our energy, right? And their time and their energy was spent mostly with toilets, trash, liability, management, driving through traffic from where they were going to the property and back and forth. And they wanted to spend more time with their family, their children, their 2 daughters, and travel, all of the cool things in life. And they're basically free and clear on the asset. And so we ran an analysis and we said, after closing costs of commissions and closing costs for the trust, about 2.35 million is going to hit the trust. And that's about at 8%, that's about $188,000 of cash flow versus 120. And so we took that 188 and we took that 120 and we did a little analysis. You know, that's about 37% more in cash flow. Oh, I'm sorry, 63% more in cash flow, right? So you go, I can have 120 or you can have about 190. And they said, oh my gosh, this seems too good to be true. You're telling me I don't have to do any of the work. I don't have to do any more, dealing with rent control or the insurance costs skyrocketing or all of these crazy things that are happening, especially in California right now. And it can increase our cash flow and have a lot of, and so the answer is yes. In fact, this is our client. His name is Warren. His wife is Catherine. And they shared their whole story on this actual mastermind a couple months ago. And if you go to our YouTube channel, you can check that out. Just go to the client success stories in the playlist and look for, I think he's one of the top videos, but it's basically Warren sharing his story and just how relieved he is to be free from the asset, increasing his cash flow, have a consistent, durable income, not having to deal with a lot of the challenges that are coming with owning real estate these days. Ross, I hope that answers the question, which leads into the next question for Jake Carpenter. He asks, well, why wouldn't everybody do this instead of a traditional DST? Okay, I'm not sure. Maybe you mean DST plus versus
I think,
one.
yes, I believe that's what he's referring to, Brett, is the DST 2.0. That sounds so fantastic and wonderful. Why would they do that? Why wouldn't they do that just all the time and not the DST 1.0?
Okay, great. I'll do Jake Carpenter to that one, and then me and Jake Miller will also tie that in. So Jake Carpenter, why would somebody not just always do the DST plus or the 2.0? I mean, 2.0 just sounds cooler too, right? It's like the iPhone's coming out. It's like the 15 is always better than the 14, right? Can you walk through the pros and cons of the 2.0 versus the 1.0, Jake Carpenter?
Yeah, so they're different. One is not necessarily better, but they're just different. And I think that actually ties into one of the questions that David was asking with, should his mother need, she's got it into a family trust, but does he need particularly a 2.0 for estate planning reasons? And the deciding factor of whether you use a 1.0 or 2.0 deferred sales trust is, what is your net worth? And that, knowing that that is a moving target, if your net worth today is below 24 million total, you may be okay because the exemptions are up to 24 million. But again, as D. Jake Miller said, Congress with the one swipe of a pen can change those thresholds, and they're probably going to come down. In 2026, we're expecting they could do as much as cut in half. So that means $12 million net worth per couple in 2026. So the deciding factor is primarily, if you were to pass away right now, would you be under the exemption of 24 million? If the answer is no, and you're on the verge of selling a $30 million asset and you're a $50 million net worth, then you probably want to consider at least using the 2.0 for as much of those proceeds as you need to reduce your estate to where you believe you're going to be okay with estate tax for estate tax purposes.
Perfect, Jake. Perfect. He nailed it, right? So first thing is, do you have an estate problem? That's the big question. Well, it's a simple equation. Hey, Mr. Seller, what's your total net worth? It's $100 million. Okay, great. Of that $100 million, how much of that total wealth is inside of your taxable estate? All of it. Most people, it's more, and they've gifted maybe some of it, right? But let's just say they say all of it. Okay. Of that $100 million and all of it's in your taxable estate, how much of that is tied to your investment real estate properties or your real estate or whatever assets you have? All of it. Okay, great. Well, what is your plan upon your death? And again, some people are unaware of the difference between a stepped up basis and the estate tax, which is completely separate. The stepped up basis does not solve the estate tax. Once you actually clarify the problem and also the consequence of not taking action means within 6 months of you passing away and the estate is assessed a 40% death tax above the exclusion amount. So back to what Jake said, in 2026, if they're a married couple, 12 million would be excluded, which means 88 million would be subject to a 40% death tax. So let's do the math. So Mr. Seller, that's $88 million at 40%. That's $35 million. So what is your plan for your estate to pay the $35 million? And this is when people are like, they lose blood in their face and they just like, oh my gosh, they go pale, right? Because they're not sure, right? Now, if they're worth $100 million, they're more likely have an idea and they probably have done some planning, right? They've done some gifting to kids. They have done some life insurance and they're planning on giving it to charity. But what we found is most people, they run out of time or they run out of kids, or life insurance is just way more expensive than they wanted it to be. And so when they find us, they say we've gotten some of it out, But the DST 2.0, it's so remarkable. You can list and sell their building tomorrow, fair market value to a third-party buyer, right? Using the DST Plus, our company can help set everything up and get everything in order for all of that. And upon the exit, all of that money in this scenario, let's say it was a $100 million apartment complex, to keep it simple, is now outside the taxable estate. And let's imagine they're still like 50 years old or 60 years old. They're still pretty young. Well, that 100 million, not only is it, you've eliminated that $35 million estate tax, but number two, all of the growth is outside the taxable estate. That's remarkable, right? Let's imagine every 10 years you can double the money, or every 5 to 10. And that $100 million is 200, 300, 400. You can see where this can go, right? It can go up very quickly, which means this estate tax is the, big domino that everyone has to figure out. And so 2.0 is 100% estate tax, number one. Now, why wouldn't you use a 2.0? Well, you don't have an estate tax challenge, but also you also might use two trust, right? You can use a 1.0 and a 2.0. In fact, that $100 million exit, we would probably recommend the first 10 million on a 1.0 because that's the more flexible income stream. What does that mean? Well, that means that it can adjust more. The 2.0 is a fixed stream of income based upon your life expectancy. It pays out like an annuity, which means it's not changeable. It's just like a fixed amount that's going to be paying you every year until you die. And if you're married, until your spouse dies. And that's it. That's just what it is. And the remainder goes to the children as the beneficiaries. So it's less flexible for your living, right? It's a legacy play is what it mostly is, but it's also cash flow and you're still receiving a great income. And if it's 100 million, that may or may not be enough, but I imagine that's a lot of money that can come every year. There's an equation for that. But the 1.0, it's adjustable. And let's say we put 10 million in that. And what that means is the interest and the payment, or the payment to you can be adjusted. Also, lump sums can be adjusted with the promissory note. And so sometimes, and most of the time, we'll do a 1.0 and a 2.0 because they both serve their purpose. The next thing is on a 1.0, it's fixed with the interest rate charge, meaning at 5 million or less per person, there's no interest charge. But above that, there's an interest charge for the government. The 2.0, there's no interest charge. Jake Miller, you want to add or subtract for the 1.0 or the 2.0 or point anything out?
Essentially, you've nailed it on the head, you and Jake Carpenter both, in the sense that one is a little bit more flexible than the other. Also, there's the limitations, meaning up to $5 million single, $10 million married under section code 453, you are allowed to do DST 1.0. And so again, when we're talking estate issues, sometimes we're talking figures much greater than that. I guess one thing to add is that sometimes our clients have DST 1.0 as well as DST 2.0, so that they can benefit from the greater flexibility of DST 1.0, and also so that they can benefit from the greater estate planning aspects of the DST 2.0. And so there's a little bit of something for everybody. There are certain limitations that we have to live within, and that's why we help individuals navigate these guardrails. And we work together as a team to help everybody find the best and most tax optimized outcome possible.
Absolutely. And that's Jake Miller, by the way, MBA, MACC, CFP. He also served our country in the Army, and he's with strategictaxsolutions.com. If you're wondering, like, hey, these different websites, different people, we all work as a strategic alliance that form this team, right? It's almost like it's the Navy SEALs, it's the Green Berets, and it's the what's the other one? I guess MARSOC for Marines, right? We have to see like we're all on this special assignment to come together and work together because we each have each area of expertise. Also creates accountability and transparency, which is always great and good for everybody. So, all right, we have back to David's questions. Is there a max time limit that it can be deferred for? So there's no max time limit, David. In fact, we do 10-year notes for the DST 1.0, and every 10 years you can renew it for 10 years, and you can pass to kids, and they continue to renew. And that's, a very likely outcome for a lot of folks who don't need or want all of the principal in a short period of time. They just live off the interest and the cash flow and pay tax slowly around that point. And on the 2.0, it's your lifetime, right? And the children are the beneficiaries there, and they can inherit that at the end. And so no time limit. So that's the answer to that question. I think you might have had another one. You said there would be around 350 of increased value from purchase price. Yeah. So the valuation there, David, seems a little skinny for us, right? In fact, it is skinny for us. We like to see $1 million net proceeds, $1 million gain. And that's important because we want to have enough pain being tax, to go through the, all of this, right? Pay for the fees, the complexities, setting it all up, right? It's got to be large enough. And then on a primary, we actually even want an even bigger one as well. We typically want a $2 million and a $2 million net proceeds and a $2 million gain. The reason is because it's a 121 exclusion. If you lived there the last 5 years, you get 500,000 married, 250 single, right, of tax-free money. So it's got to be bigger. However, I will say we did a $250,000 deal for our client in Texas because he had a $10 million total portfolio of the properties, right? And that 250 was more like an opportunity for him to test drive everything and get a feel for it before he rolls all the rest of them into the trust. On a standalone deal, we wouldn't do the 250 or the 350 for yours. But if you said, Brett, they've got, $5, $6, $7, $10 million worth of other assets that they could probably, and most likely, if it goes well, move into the trust, then we can scale all of that. So hopefully that answers the question for you, David. And if you want to learn more about all of this, you can go to capitalgainstaxsolutions.com. As well, you can check out the brand new book called Building a Capital Gains Tax Exit Plan. It's the proven playbook for unlocking your ideal wealth plan when selling any asset of any kind for yourself or your clients, friends and family. Check out on YouTube as well. We also have a ton of content there. You can, if you're watching this, you can like the video, you can subscribe. And we also have D. Jake Miller in the book for this one. And we have Kevin Harrington from Shark Tank, which is pretty cool. I got a couple of chapters as well, so check that out. Go to Amazon and check that out. All right. That being said, does anyone else have any other questions? Got a good rhythm there. And happy to answer more for anyone. Otherwise, it's happy Friday to everybody. And we can depart from here. Rebecca, go ahead.
So I've never asked this before, but it sounds like you can't stack the 1.0 version on a couple of them, like 3 or 4 of them on top, and not do the 2.0. That makes sense. So if you just sell one property, you can only use the 1.0 once, and then you have to go to the 2.0. Let's say it's a $50 million property.
Nope. So you can do as many as you want in each of the trusts. Okay. So you only need one trust. You could do 100 deals or 1,000 deals, and the other trust, you do 100 deals or 1,000 deals, right? The question is which one's going to solve the challenge, right? So you can do a 1.0 and do 1,000 different exits, and the 2.0 and 1,000 different exits. But sometimes you might want to do, 2 exits in the 1.0 and 3 exits in the 2.0, right? So it's not a cookie cutter, one size fits all template. We're going to see the unique fact pattern of the client. We're going to see the unique fact pattern of what they're trying to do, and then say, okay, based upon that, here's the prescription, right? Based upon the X-ray and the MRI and the blood test, right? Here's the way to get the ideal outcome. Does that make sense, Rebecca?
Yes. Yeah. Perfect. Thank you.
Absolutely.
Also, I would add that and Brett confirmed here, I believe the 5 million single, 10 million married filing joint limitations on when you must then use a DST 2.0, that's applicable per year, if I recall correctly. And so, if you have a $6 million deal now and you're married, $7 million deal next year, and you're married, my understanding is that you can do DST 1.0 on both of those.
Yeah, it's a good point. Right. So yeah, there's limitations per married couple per year. But let's just imagine like Jake said, you sold a $9.9 million deal by December 31st of 2023, right? And that's great. You can defer 100% with no interest charge on that 10 million. 2 days later, in 2024, you could sell a $10 million building, property, business, whatever, and you can use the 1.0 on that as well. So yeah, I get what you're saying now, Rebecca. You're saying the limitations, if you go over that out. And by the way, you could also do $1 billion in the 1.0. There's actually not a limitation. There's just an interest charge that the government's going to charge you, and it's going to blow the whole deal up. And so otherwise, it's a 0% interest charge, right? So that's why we're going to map out exactly. And that's really our main focus. Every single day, Jake Miller, Jake Carpenter, myself, our team, our strategic alliances, we're trying to figure out ways to make this an investment and not an expense, right? And you've got to know these intricacies and these details so that it's a success for everybody. So hopefully that makes sense, Rebecca. Cool.
Great questions.
Yeah, great questions. Anybody else have any other questions for the Brain Trust here? And we'll do our best to answer them concisely. We do have another one from David. Other than real estate, what other things could be placed into a DST? Jake Carpenter, what assets can be sold into the deferred sales trust? And maybe even talk about the recent mobile home park exit that you helped your client, you and I helped your client with, and how that all went.
Yeah, so as long as it's a qualified transaction, meaning $1 million net proceeds and $1 million subject to capital gains, really anything that fits, anything you can sell, as long as it fits that criteria, could be appropriate to use the deferred sales trust. This could be cryptocurrency, it could be a collector car portfolio, it could be art portfolios, it can be businesses, it can be real estate. So just about anything you can think of that would appreciate to a level where there would be $1 million subject to capital gains tax and $1 million of net proceeds. So let me give you an example of one of the deals that one of the last deals that Brett and I worked on, and a good example of how our team works together is I had a client who he owned 5 mobile home parks. He ended up getting a really, really good offer that just came out of left field, $10 million. One of the things that he said that we covered earlier in this segment was where Brett said, hey, you can lock in those capital gains, the appreciation on your asset, and sometimes you can increase your cash flow. Well, that's exactly what happened with him. He sold 5 parks for $10 million in one deal, all packaged together. And after the fact, he says, you know what, Brett and Jake, my cash flow doubled because I was able to harvest the capital appreciation and redeploy, so it was creating more income. So, and this was a really neat deal because we first went into a 1031 exchange to remove debt over basis, which we cannot defer capital gains on. So that's another thing you got to pay attention to, and another reason why to use this team here. Once we replace the debt over basis, we drop the remaining proceeds into the deferred sales trust from the qualified intermediary. And we even had Jake Miller and myself had to work together on that case. So just because we're both financial planners or investment advisors does not mean that we don't work together. And we are a great team, not just me and Jake, but Rebecca, Brett, we all work together, rowing the oars in the same direction to make sure we're getting the maximum amount of efficiency and coordination into your transaction.
Very well said, Jake. And then what we're talking about is the artful game of capital gains tax exit planning. And it's an art and a science. And I had my Rubik's Cube, but then my son took it. So I got to go find it again. But sometimes it's like trying to get all of the colors on the Rubik's Cube to match up. And when it matches up, everything goes great. Now, sometimes you pass that Rubik's Cube to me and I can maybe get one side, maybe a side and a half to match up. I'm still working on it. My daughter can do it and it just blows my mind. I don't know how to do it. But you can pass it to Jake Miller. He can move it more, pass it to Jake Carpenter, pass it to the tax attorney CPA. And typically that's when everything lines up and it's all succinct. And so it's definitely a team effort. What would you use to accomplish the same outcome if less than 1 million? Great question, David. It all depends, right? So there are some strategies using what's called cost segregation and bonus depreciation that can solve smaller amounts. And in fact, we do multifamily syndications, and we will buy deals and partner with those who buy deals to produce some smaller amounts of depreciation to offset smaller amounts of capital gains tax. So pros and cons to that as well, right? These are illiquid assets that are typically tied up for 3 to 5 years. No control, no liquidity, right? No diversification. But if you can find the right deal with the right operator at the right time, and it's a smaller amount, okay, right? That can be a good fit. And so that's what we typically do. If someone comes with a smaller deal, it's not a good fit for the deferred sales trust, we will work and invest typically with multifamily value add properties, bigger, better locations where they're putting in smaller amounts to offset their tax. Jake Miller and Jake Carpenter have some other creative stuff too, maybe with some oil and gas stuff. And so depending on the risk tolerance level of those who are looking at, capital gains tax and those type of investments, that can also be a solution. So hopefully that answers the question. David, Jake Miller, want to add anything to that?
I just say that there's a lot of different tax strategies out there. This is one. This is one that can be a really big one in the sense that it puts power of timing back into your hands. If you have a transaction that may not be eligible or it's just not a good fit, what have you, there's a whole other bag of tricks out there that can possibly help you with your specific situation and scenario. Everything from the oil and gas that Brent mentioned to charitable mineral strategies to yada, yada, yada. No, there's a lot of things that you can do. And again, reach out to one of us and we can help share more with you. So that the last thing that we want to do is and this is perhaps rare in the industry, but we don't want you to get into something that's not right for you. We only want to optimize your specific tax scenario with tax savings, with tax deferral, with tax exemptions, with the tools that are correct and perfect for your situation. And so we'll be the first ones to tell you that it's not a good fit if it's not a good fit. But for your specific scenario, feel free to reach out. That's why all of us have websites. That's why we all have a method and means by which you can contact us and we can guide you through that process.
And that being said, Jake, we're out of time. Where can people find Jake Miller if they wanted to find you right now?
strategictaxsolutions.com. Again, strategictaxsolutions.com, as well as alphamarkcapital.com.
Amazing. Jake Miller, if people want to, Jake Carpenter, if people want to find you, where can they find you?
509-396-5292 or carpentercapitalllc.com.
And Rebecca Munson, if people want to find you, where can they find you?
530-448-9740 or RebeccaMunson.com.
Amazing. And thank you, everybody, for attending another mastermind. Again, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated assets, defer capital gains tax, grow your wealth, unlock freedom, but also understand that it's not just so simple. It's not always a 1.0 or 2.0 or DST at all. It's having that team that you can help you, guide you toward the plan and the exit that you want to be at for your wealth, for your plan. If you're watching this on YouTube again, I really encourage you to please like the video. That helps the algorithm. It's going to help people to see more of this content as well. If you subscribe, you're going to get first access when the new videos are released. We also have a top-rated podcast. We're interviewing some of the best in the business on wealth and real estate. You can check that out on YouTube and on iTunes or wherever else you do podcasts. And then lastly is the book. Check out the book, Building a Capital Gains Tax Exit Plan. We still appreciate everyone out there, and we will talk to everyone again soon. Bye, everybody.